All right, awesome. So guys, thank you so much for joining. I greatly appreciate it. My name is Agostino Pintus. If you guys don't know me, I'm the host of Bulletproof Cashflow podcast. But one of the things that I also do is I'm a practitioner in this space. So I buy large multifamily deals, also getting into development as well as triple net, single tenant, triple net type of leases as well. But my true focus has been and it continues to be multifamily. So, and just to share something with you guys really quick is this. So right now we currently have, this is our map of our assets, right? Really throughout Cleveland, the Metro Cleveland area. Okay. Some of our assets are here. Here's a deal we have over in Cleveland or in Euclid. This one is in Akron. You might recognize this one, Craig. This is over near on Howe Road, right down the street from Target, right? Beautiful Class A area. Got this a couple of years ago. It's been performing solid performer. This is the Las Colinas deal we bought. It's 10 buildings over in West Cleveland. Picked it up for a great asset. Picked it up for like 28 a door. Got into that one, renovated portions of it, fixed up the whole outside, rebranded it, and increased value tremendously. We were able to bang up rents by like $150 a unit, so great job with that one. This is a little deal out in Canton. This is, there's 5 buildings out there. And what else? Of course, we have, this is, I've had some smaller deals as well, like this one, but then there's also nice big deals like the Rockefeller that Don was just talking about. This is going to be a Class A asset in downtown Cleveland, right next door to the Sherwin-Williams headquarters. Heavy lift. But you know what? It's going to be a phenomenal deal for us, for the investors, and of course for the city as well. It's just going to be absolutely huge, right? This is an asset that we just closed on a couple of weeks ago, the West Terrace deal. And this little deal is also in West Cleveland. We're also looking at buying another deal over in West Cleveland as well. So we're looking to really increase the count by another 400 units by the time the year's up this year. Right? So 30 days, I have 30 days to find them. Now, the reason why I'm showing you all this is not because I'm showing off, right? My intent is not to show off here. My intent is to show you guys I'm an actual practitioner. Everything I'm about to tell you is based on years of pain, years of making mistakes. And I hope to dispense all this information to you guys in the hopes that you can avoid some of the mistakes that I made. Right. So I started buying single family 16, 17 years ago, something like that. And really, I did it on a whim. Right. A friend of mine says, hey, you ought to buy your single family real estate. And I was an executive at some publicly traded company. We had money coming in. I was a young guy. I'm like, okay, sounds like a good idea. So I went ahead and did it. I mean, there's no real rhyme or reason. There was no concept around building legacy wealth or anything else like that. It was more along the lines of just, it seems like a good idea. I'll get some extra cash flow. That's it. And that's important that I mentioned. I'll explain why in a second. But what I did was I started doing single family and small multifamily. And I one of the things that I come to realize is that if I'm able to do this enough times, I can eventually replace my corporate income, because I was always operating in fear all the time. I was always afraid. I was always afraid of getting fired. I was always afraid of something happening to my job, even though I was a successful C-level executive. And it's one of those things that once I was able to get out of that whole scenario of that busted up mindset and learn about how to buy the right assets and really build a bulletproof mindset, I was able to shift my whole thinking. And the reason why I'm bringing that up is because before we go into this making the jump, there's 2 things you really have to consider. And I would ask you guys to really think about to make it really integral if you haven't already. And the first thing is really getting into the habit of thinking bigger. And the reason why, obviously that's why everyone's here right now. It's why all you guys are here right now. You're already thinking bigger. You want to do bigger deals. I have, we run local meetups here in Cleveland. I've been to many other meetups as well. And there's many folks out there that currently do single family, they want to even jump into single family, and they don't do it. They're scared, or I gotta, whatever reason they come up with a reason, and yet they keep reading the books and they keep listening to the podcasts, and that's good, but it's going to require taking action. And I'm prefacing everything I'm about to say with that. Everything I'm going to tell you is based on stuff I've actually done, but you have to make taking action an absolute critical piece to your success. You have to do it. And what does that mean? It means more than just reading a book, because our brains have a way of tricking us into thinking that we're doing something when we're reading a book or listening to a podcast that actually isn't doing anything. What matters is now partnering up on a deal, getting in on a deal with someone else, even if you're doing it as an LP with someone, even as a limited partner with somebody, fine. Even as boots on the ground, fine. Even as you are helping someone buy the deal, bird dogging, anything, just to take that step towards making it happen. Super, super, super important. You have to take action. That's the toughest part for this whole thing, is breaking the daily habits that run all of our lives, getting out of that, and then taking action. So I can't stress it enough. So since we are here in December right now, maybe you can make January the time to really consider how are you going to spend the next 12 months afterwards doing that, right? Are you going to invest as an LP? Are you going to go ahead and sign up for coaching? As I had a student actually sign up for coaching recently. She didn't even know what a syndication was at first. And now she's buying into deals. She's a general partner on deals now. I've had numerous success stories like that where they didn't even know how to structure a deal, and by signing up for coaching, they're able to get into deals now, right? So part of it is confidence, I think, but the point is that they took the action to make it happen, and that is absolutely huge. So I trust that for everybody that's listening to this right now, you want to make this a part of your life. And I'm telling you guys, as a guy that did corporate, as a guy that worked at the C-level for publicly traded companies with big income and all that fun stuff, cars and houses and all that, there's not a single day that I wake up now and I say to myself, oh my God, I miss corporate life. I've never, ever, ever, ever said that. I never will say that, right? My whole life has changed. And I'll say real estate had a lot to do with it, but it was getting to the right mindset, building up the bigger mindset. And secondarily, which is almost as important as the first one, is writing down your goals. Writing down the goals every single day with your intent as to what you want your life to look like is absolutely critical. You have to do it. And it's one of those things that I thought it was a bunch of crap. I thought it was a bunch of nonsense, honestly. I'm sure some of you guys, if you're into the whole motivation thing, you've probably heard of The Secret, right? The book. That when I first heard about it, I'm like, come on, really? People fall for this crap? I'm telling you, that stuff works. It works. I'm telling you, it works. So what I do though is I write out my goals as if they've already happened today, right? I own 50,000 units producing a 12% return. I own 4 houses by the beach in South America. I mean, they're very, very specific. And as I'm writing them, I'm thinking about it, I visualize it, I internalize it. And then I'm feeling the emotion that's behind that intent. And when you take that approach, as opposed to just writing stuff down, your mind does not know the difference. Your subconscious does not know the difference, right? And your brain starts looking for those things to make what you wrote down real. And again, the reason why I'm bringing this up is because when I decided, that I was going to have, my first goal was 100 units. I'm going to have 100 units in 3 months. And I kept on writing it down over and over and over. If I felt down one day, I got off a phone call with some broker and he hangs up on me or whatever. I was upset at first. I sat down and I wrote it out, because what happens is that your reticular activating system, right, in your brain starts looking for the opportunity to make that real, because as far as that's concerned, it is real, right? So it's kind of important that as you're going through all this, right, those two key aspects have to happen. Because listen, I'll dispense everything you guys need to know, that those 5 things that I mentioned in the video. I'll talk about all that, but without those 2 fundamental things at the beginning, it's all for naught. Nothing happens. Nothing happens without having the mindset, without having the goals. Nothing will happen, right? You got to have it. So, and again, I'm telling you guys from practical experience. When Don and I were talking about the Rockefeller Building, some of you guys might be familiar with it, but the Rockefeller Building is the iconic property here in Cleveland. It's sitting on a corner right next to what ended up becoming the site where Sherwin-Williams is going to be building their world headquarters, right? When I first saw that building, I decided immediately that I'm going to buy that property. I'd never done a new development at that point, never did it, but I decided that's what's going to happen. And, come hell or high water, it had to happen. I wrote it down on my goals. I own the Rockefeller. I own the Rockefeller. I wrote it down every single day. Every day I wrote it down, and it made it real. That is a real life example, and that's happened for numerous things. So and I'm banging on this a little bit longer than I probably should, but it's definitely one of those things that I'm asking you to think about. If you're looking for help on how to do that, let me know. I mean, I'm happy to provide you with some guidance around that. It will, in terms of like how you structure it or what to say, or because all those things matter. They definitely matter. So anyway, as I go through these 5 key things, okay, about making a leap to multifamily from single family, feel free to throw any questions you have in the group chat. Hey, Will, I just got your message. Thank you so much. I'm glad you joined. I appreciate it. But feel free, guys, share any questions, share any thoughts, raise your hand, interrupt me. Let's keep it open. I'd love to keep a dialogue going. Okay, so let's get into it. So the first thing you have to really be keen on is understanding understand there's very different numbers, very different terminology that's related around the multifamily space. Okay. Multifamily is more than just property, right? It's another asset class, right? Single family, most of us are accustomed when we're growing up, we live in a house and this is just our home. We internalize this is like that whole thing about home is where the heart is, that kind of thing. Well, because this is where your family lives, this is where we reside, and this is where all your friends hang out and whatever, right? Really, it's an asset class. It's an asset class. That's all it is, right? Same thing with multifamily, same thing with industrial, same thing with triple net and development and whatever, right? So, but with that asset class comes a very specific terminology, a very specific mode of speaking when you talk about multifamily, right? So what does that mean? You have to understand what a rent roll is, what's a return on investment, or what's an ROI, what's a vacancy factor, what's a physical economic vacancy versus physical vacancy, and how are they different? All these different things. In the single family world, you don't really talk about it all that much. It's not really mentioned. It's the math is pretty, you buy it and you're going to pay your loan off and pay off the taxes, and here's your return. Great. Awesome. Got it. Put in the bank. Easy. With multifamily, it's very, very different. And the reason I'm bringing that up now is because you have to spend a great deal of time trying to understand the different terminology, right? Because that's going to be the key to getting more deals as you continue growing your portfolio, right? So what that means is that understanding, for instance, that when you get a pro forma from a broker, okay, what is a pro forma and what does that mean to you, right? And for those guys that don't know what a pro forma is what a broker will prepare for you on an asset that they say the one that they're trying to sell it for some obscene amount of money, right? The first thing you do with a pro forma, by the way, is throw it away. All right, it's the first thing you do. Always throw it away, and you come up with your own numbers, right? But in order to do that kind of thing, you really have to understand how those deals are structured, how they're put together, and again, understand the terminology. And this part is absolutely critical, because here's the thing: eventually, once you understand the terminology, once you understand the math that's behind it, right, in terms of how to analyze a deal, you're going to start calling on brokers, okay? And you're going to call on a broker one day. And one of these brokers can change your life if they believe that you are a real buyer. But then you know what? The guy asks you, ask you a question about some, whatever, what ROI you're looking for, whatever, right? Some basic terminology stuff. And you can't answer the question because you don't know what he's talking about. The second you do that, you're done. You'll probably never get another chance with that broker again. Maybe, right? So that's why it becomes absolutely critical to make sure you understand all those key aspects around the language of real estate. Now, on the Bulletproof Cashflow YouTube channel, there's the multifamily mindset. There's a playlist there. I don't even know how many videos I have there, but I talk about a variety of these different terminology. Feel free to go there, watch all of them. I mean, they're very straight to the point. There's no fluff. Just go listen to them, play them in the car, that kind of thing. Yeah, and it doesn't try to sell you anything or anything else like that. It just delivers the goods. That's it. I think that might be a good way for you to really start understanding the terminology, because once you understand the terminology and once you know how to underwrite deals, which is another key aspect of how to put a deal together, then at that point you become ready to really start looking at an asset and understanding what you're buying. Now, I did put a couple of links in the chat box. There's I think it's one of them is the guide to finding a broker. Yeah. So there's that for either one of those. When you click the link, it's going to send you to a web page. You put in your name and your email address. It'll email you a bunch of information, a bunch of stuff on how to approach that aspect, because the brokers are going to be the key to getting your deals. It's the brokers. It's not LoopNet. Okay, LoopNet is never the answer. All right, LoopNet typically has a lot of rougher deals out there. I'm not saying you can't find anything there. But it is a good spot for you to find brokers, get to talk to them, get to know them. And I find it's also a good place to practice how to understand the terminology of a deal, right? How they're put together, downloading the different offering memorandums, reading through them, how they put together, what are some of the terminology that they use in these different OMs. And if you don't know, and OM means offering memorandum, if you don't know a term, then you Google it, read about it, understand it. All right. This part is absolutely critical. And by the way, before you do call on brokers, never call on a broker that you want to talk to in your market first. Call a broker outside of your market, right? So that way, if you do make a mistake, it's no big deal. So maybe Don is he wants to practice talking to a broker, wants to practice his script. Well, he's not going to call a broker in his neck of the woods. He's going to call a broker in California, because none of you guys are going to buy anything in California, right? No, the answer is no. I'm going to answer that for you. None of you guys are going to buy anything in California. So you call them in California, right? Practice, right? And then see how you do. If they call you back, then that means you got a good script, and then you can start calling on your local people, right? So that's a handy dandy little tip there that will pay you dividends. But the key is you don't want to look like a newbie. You don't want to look like a newbie. That is absolutely critical, right? The second thing to realize is that there's a lot of paperwork and increased time frames. Okay. When you're doing a deal of basically it's 5 units or greater, right? So I think sounds like for most of you guys out there, you guys have done some single family, you guys have done some small multifamily. Some of you guys have never done a deal before in your life, and that's okay too. The thing is that when you're dealing with five units or more, Now you're dealing with commercial. It's a whole different animal, right? It's classified as an investment property, as opposed to the single family or up to 4 units. I'm sure there's people on here that did the whole thing where, oh yeah, I'm going to live in one of the units and I'm only going to put 3% down and yada, yada, yada. You can do that, whatever, you can certainly do that. No one will ask any questions and whatever, it's fine. That's a whole different thing. Those are all backed by Fannie. You're now, when it comes to commercial, different. Okay. And the reason I bring that up is because there's a higher level of due diligence. There are very few, if any, consumer type of like protections, so to speak, right? It isn't like you have all these like sort of consumer protection laws and all that stuff when like you do in a single family. You don't have any of that stuff with commercial, right? So it's very, very different. It's a whole different thing, right? Now, here's the thing. Typically the lender is going to require a great deal more information. You may have to do like a phase 1 or phase 2 environmental, like we have to do on some of our deals. The lender requires that we have that they like, is there dry cleaners nearby? Was there oil spill or something nearby? And how's it going to impact this asset specifically? I mean, that's just environmental. All kinds of different things that go into the underwriting of an asset like this, right? So it's going to take a little more time. Now, in general, whenever I do a deal, I typically it's a 30-day due diligence, 30-day to close. That's when times are normal, unlike what we have going on today. Sometimes I'll put like a 45-day due diligence, 30-day close, or 45 due diligence, 45 close. It just depends, But typically there's some sort of longer period for both of these two different windows, we'll call them, right? You may also elect to put, let's say, an extension clause, right? So I'll extend by 15 days. And if I extend by 15 days, I'll put up $5,000 or $10,000 or $20,000, whatever makes sense for the deal, right? But again, the reason why I'm bringing that up is because I've had people come in and buy assets from me, right? And they'll say, oh yeah, 30-day due diligence, 10-day to close on a commercial deal. Is that right? This person's not closing. There's no way. They won't close this deal. I knew they wouldn't close the deal, right? Because that's not how those deals are done. They're not done that way, right? No commercial lender is going to do a deal that quickly, right? Now, maybe you can get hard money, but again, hard money is going to take, it's still not going to take 10 days. It's going to take longer than that. So again, it's one of those things that it was a newbie, and of course they never performed, and I knew they wouldn't. That's a key thing that you have to understand, that when you're putting these sorts of deals together, okay, it's going to require a great deal more effort, it's going to take a little bit longer to get it closed. And you still want to hit those targets as best you can. All right. Hit those targets as best you can. If you don't think you can close this thing in like 30 and 30 days, 30 days to close, if you don't think it's going to happen, when you talk to your broker, if they say, I don't know if we can do it, put it on your LOI, communicate it to the brokers, be as transparent as humanly possible, and always return the phone calls. That's also key too. But transparency is like, it's like gold in this business, right? If the person that's selling you the deal has confidence in you, that you're communicative, you're speaking, you're always talking to all the brokers and everyone involved on a regular basis. You don't just disappear like some people do. They'll feel comfortable with the decision they made to sell you the asset. Okay. But it all comes down to properly evaluating your due diligence period and your financing period. Right. So again, 30-30 is a normal. I'd say these days 30-45 is probably whenever there's like, some sort of slowdown, economic slowdown. These days, like I said, I would put a 30-day due diligence, 45-day to close, with maybe 1 or 2 extensions of 15 days, with some sort of cash put into escrow if something happens, that kind of thing. That's generally what I've been doing anyway. So there's that. So I would say that the number three, the capital requirements. Now, when one thing when it comes to these types of assets is that this business is a very, very capital intensive business, very capital intensive. Why? Well, because you're usually dealing with bigger numbers, and you have to become very, very good at, of course, raising money. That's a big part of it, but also properly evaluating what it is that you're buying, as well as making sure that the asset that you're buying is what it's supposed to be, and in terms of all the things needed to make it right. Typically, everyone on this call, anyway, I would imagine you guys are looking for the typical C class, B minus value add asset where you can go in, fix it up, make it better, bang up the rents. I mean, that's the basic formula that I think most people are following, and that's okay. I think we're all following the same sort of thing. But one big mistake that people made, and they continue to make, is, oh, I'll just pull it from cash flow. No, don't do that. Don't ever do that. Don't do that. You never pull it from cash flow. Raise all the money you need. Go through the asset. Understand what you're going to do to the property, right? Are you going to replace the kitchens? Are you going to do the cabinets? Are you going to do the flooring? Are you going to do the painting? Get understanding as to how much it's going to cost to do all this, and then raise all the money needed to get the job done. All of it. All of it. Don't ever think that you're going to pull it from cash flow, ever. It just doesn't work that way. It's never worked. I know people personally that have tried to do it, and they've always failed miserably, right? Why? Well, because they usually underestimate other things that come up, right? Or maybe their occupancy drops. It seems to be the case for some assets where right after an acquisition, occupancy drops by a little bit. Don't know why. It's happened on just a couple of assets where occupancy will drop by, like, say it's at 97% when we acquire it, which is rather high. It might drop to like 93 all of a sudden. Then it comes back up. Don't know why that happens, but it's happened on at least 3 deals, right? It doesn't happen all the time, but if that happens, especially on a smaller deal, which some of you guys might be getting into, maybe you're considering jumping from, like, say, maybe you got a bunch of single families and you want to jump to a 22 unit. When your occupancy drops that much, it's material. It becomes a problem. On a big asset, like, on my 200 unit deal, I mean, if it drops that much, I mean, yeah, it sucks, but it's not gonna kill the deal. It'll still cash flow. On a 22 unit, you drop 5 percentage points. That's a problem. Now you got a problem on your hands, right? So that's the thing. I mean, never ever pull it from cash flow. Don't ever do that. Have a good understanding as to what you need capital wise, and then raise all the money that you need to get that deal done. Super important to do that. And this could be, maybe you partner up with somebody. We typically syndicate our deals, but I think, again, for the smaller properties, I'm not big on syndicating smaller properties anyway. I'd rather do like a partnership or something along those lines with other folks. Well, back then anyway, I don't really do small deals anymore. But I would recommend that, let's say, for instance, Jack finds a deal. Maybe Jack, Don, and Craig, they all partner up to acquire this asset, and they're going to fix it up and bang up the rents, and then refi it and pull the money out and just cash flow it till the cows come home. Super. Maybe between the three of the guys here, they can raise the money they need or get the money out of their 401ks and do that deal. On a small property like that, that's what I would do, but here I have a question here from Josh. So do you normally use the same lender for refinance as you did for the purchase, to have them involved through the whole process and have a more accurate ARV? Good question, Josh. It depends. So sometimes a lender will put in, I forget the name of that fee. There's a fee that they'll charge. I forget the name of it right now off the top of my head. It'll come to me. But basically what they're going to do is they'll say, like, if they want to do the refi, like, they'll do like a bridge, So I'll give you an example. We bought that one asset in Euclid. It's 126 units. We paid $4 million for it, just over $4 million for it. And we were going to renovate it and then refi. And we ended up, if we were going to refi, they would waive a 1% fee if we we're going to keep the refi with them. But if we refied it with someone else, they would nail us for the 1%. And we ended up refining it with someone else because they gave us a better rate, they gave us better terms, they gave us interest only, they gave us a bunch of other stuff. So we ended up having to pay out the 1% to those guys, and it was still worth it. It was still worth doing the deal, right? Still worth doing the deal. We were able to, we made a nice chunk of change on that deal, paid back. The investors are happy. We were happy. It just turned out well. So it just depends on the deal, right? Also, if you're using like Lima One, for instance, right? Lima One, they tend to be somewhat, I'm not going to call them hard money, but they're expensive. They're expensive money. They'll do those types of smaller multifamily type deals. They don't care, like if you go and refi with someone else, right? So, like I said, they're more expensive, but that lender doesn't care. So it varies from lender to lender, right? But that's a good point, though, is to understand what those rules are, right? Make sure you have a good attorney, a sharp attorney that knows and understands how that stuff works. Because I'll tell you what, if you just call your buddy up the street who happens to be an attorney and he does, I don't know, family law or something like that, I'm sure they're a nice guy, but if they don't know what they're doing around real estate and they're not familiar with real estate transactions, you're going to have a problem on your hands if something bad happens, right? So you want to make sure you have a good quality attorney in your corner that knows what they're doing and can help you understand those nuances of the deal, right? Of the financing. Financing is absolutely critical to making the deal work, by the way. Don's asking, is there a minimum number of doors to start? Man, I'll tell you. Oh my God. Lately I've been telling folks that like I started with small deals myself, right? I started with like I started doing small multifamily, and then I started doing bigger multifamily. Like I did a 12 unit deal, and then then my 22s, did some 22s, some 28s, and it started scaling up from there. I would say that I would not, if I could skip over those 20x deals, I would totally do it. I would never do them, right? But I also understand too that for some folks out there, they kind of have to. I find that between 2 units and I'd say 12 units is easy to do, right? Because you can almost self-manage those. And then from 60 units and up, those are easy to do because if you hand it over to a management company, they'll do a fairly good job managing the asset. Here in the middle seems to be a space where the managers don't care about the asset. I don't know why. The property manager doesn't care about the asset, and it doesn't make enough money to make it worth your while, right? So it's kind of like, and it's kind of like, it's almost like the twilight zone here in the middle, right? I would almost recommend, this is what I've been telling, I told some of my students and people in passing that asked me this very same question. You buy into the deal, you fix it up, sell it off, get the experience, get the number of doors, get the doors under your belt, fix it, sell it. Unless you have good management, unless you have good processes, unless it's like, and then there's all kinds of different unlesses in here. If it's a good property, like say you're buying 28 units in downtown Dallas, okay, that might be fine. But if you're going to do like 28 units in a tertiary market, meaning a market that's far away from any major metropolitan area, you're in for a hurting. You're in for some pain at that point. Why? Well, because you're going to have a harder time filling those units. Depending on how the courts are, if they are very sympathetic to tenants, evicting people is going to be an issue as well. So there's all kinds of little nuances around it. So I mean, I strongly recommend the bigger, the better. But I also understand too that it's not always possible for people. But you know what though? Listen, if you haven't started, if you're at 0, start with 1. If you're at 1, go to 4. If you're at 4 now, fine, go to 12, or even buy another 4. You know, just keep moving forward, adding to the portfolio. If you're going to do that too, I strongly recommend buying local in your area, especially with the small deals. That way you can keep an eye on it. And I say local, like no more than 30 minutes away. Like keep it small, keep that circle small. I mean, I've had deals that were an hour away, and I at first thought, oh, it's only an hour, not a big deal. Oh no, it's a big deal. an hour to go look at some property that you're already pissed off at, and then an hour back home. Then you're burnt up, not only about how much money you're going to lose on that property, but then you're also burnt up about the 2 hours just spent driving back and forth. Don't do it. Stay local, stay close. And then but I think the key though, you know what is, it's what I said with point number 1. When you're able to speak with confidence around your deals, and you get some deals done, fine. You buy some 4-plexes, maybe you buy an 8-plex or a 12-plex. You know, you do 16 is probably the absolute minimum that I would probably do. But either you buy it, hang on to it, turn it, and sell it off just to get the experience. But the point is that when you have everything like that, like I just lined up, and you're able to speak to someone with confidence that you know what you're talking about, like I say with someone like, say, a bigger syndicator, they may connect with you and they'll say, hey, listen, Don, I want to buy in your area. Do you mind being the boots on the ground on this deal? I mean, I'll tell you, it's a long road. I mean, this is not, I know there's all these gurus out there on Facebook that just tell you you're gonna be drinking mojitos in Miami tomorrow if you buy their course. I can assure you, as a guy that's doing this, that's not the case. I can assure you. But it's going to take some time, but it's certainly doable, right? It's very doable, but it's building the knowledge base and getting some experience, even if it's the small deals. At least you can talk about, hey, yeah, listen, I have 28 units across these 3 or 4 deals in my local area. I know this area. I know it so well that I put my own money in these deals right here. I bought them myself just to prove that I'm for real, as opposed to a dude that's just not doing anything. You know what I mean? I think that speaks volumes, especially if you're going to go talk to somebody, a syndicator, about partnering up with them. You know, it shows that you're a real person that is really into this game, because you'd be surprised, or maybe you won't be surprised, but there's a lot of people that hit up many syndicators. There's friends of mine too. They hit me up too once in a while, and they want to get in the game, but they've not made the investment in themselves in terms of the knowledge, nor have they made the investment in acquiring an asset of any kind. You know, show me you can buy something, anything. Show me you can do at least one deal. You know, if you can demonstrate that, it makes you a better candidate to invest in. Think of it like this: you got to be worth a damn. You got to be worth a damn. That's probably the best advice I can give you with that. So anyway, yeah, but hey guys, by all means, keep the questions coming. I'll ramble about this stuff all night long if you want me to, because I just love this stuff. So let's see, number four, a larger team. You're going to need a great team backing you up with all this stuff that you're doing here. This is probably one of those key components that really help fortify, and it also helps demonstrate that you're not doing this by yourself, right? So here, again, going back to that last scenario I just mentioned, if you're like the lone wolf, okay, great. You got the data, you learned it, right? You learned the information. You bought some single families, you bought some multifamilies, super great. Who's your team? Who's your attorney? Don't have one. Oh, you have property management? No. Okay. Do you have any lenders? No. Okay. You have any inspectors? No. Title company? No. I mean, if you have nobody on your team, it's going to become very, very hard to build credibility, right? Now, the good thing is that, you can, if you're in a good market, finding those good groups can really help you build that credibility. I recommend, when it comes to property management, try to find a group that focuses on the asset class that you're looking to buy. So I'll give an example. Like I buy mostly B and C assets, more C than B, right? So I have a great group that I use, and they're excellent at what they do. And the cool thing is that when I talk to the brokers, and one of the first questions they ask me is, "Who's your property management company?" I'll say, "Oh, it's Gary." "Oh, I know Gary. Gary's a good guy. Gary's been in this market for 30 years. I like Gary." Now, what has that done for me? It helps build my credibility because Gary is a good guy, right? However, with the Rockefeller, different property management. Al's managing that property. Now, why is Al managing that, not Gary? Well, because that property is going to be an A-class asset. Gary doesn't manage A-class assets. Gary manages B and C. Al manages A-class stuff, you see? So it's kind of like you're matching up the the management company with the right asset class. And I think for most of you guys that are here right now, you're probably going to be getting started in the C-class assets, and it makes total sense to do so. Nothing wrong with it. Everybody starts there, I think. The reason why is because it's plentiful. It's fairly cost, it's reasonable cost. It's easy to get into, and there's still room to do the work to grow that asset and make it better, right? So the key though is not to find a big, giant, massive property management company. Don't make that mistake. Don't find a group in your local market that manages 20,000 units or 10,000 units. You're way too small to care about, and don't go too small either. Like, don't go and connect with a guy that manages like 10 doors or something. They're too small, right? They probably won't be around for a year, right? Because if they're not making any money, they'll probably quit. I find the happy medium is probably, I don't know, 1,000 units, something like that is probably a good starting point. If you could find a group has 1,000, 2,000, I'd say no more than 4,000 units. They'll still talk to you. They'll be nice to you. They'll want to work with you, especially if you're able to demonstrate your vision as to what you want to do. If your vision is an aggressive vision and they believe in you, then chances are they'll open their door and they'll talk to you. So interview a bunch of them though. Don't just go with the first one. Interview a bunch of different property managers. See how well you get along with them. Understand their processes, their procedures, how they report to you, what kind of systems and technology they use. All that stuff matters, right? So property manager is probably the first one you're calling on. That's why I mentioned that. The second one is probably your attorney as well. The attorney, who you partner on or who you partner with on the attorney side, it can be is very, very important as well. A good attorney in your local market will really open a lot of doors for you too. And if provided you do, you send them business, you help them build their business, they'll help you right back. And I think that becomes a key aspect in terms of marketing and branding yourself to other folks. But be a network connector as well. But secondly would be your attorney. I would focus on that person as well. Finding that person is going to be huge for you. I just got a question here. Do you typically 1099 or W-2 your property management companies? Well, so right now they're separate companies altogether. So they take it depends on the asset. So 5%. Right off the top. So in terms of income, right? So that's how they do it. So yeah, they don't work for me directly, right? These groups don't work for me directly. When they do, at some point, I'll probably end up either buying a group or building one. I'll probably end up buying an existing company, I think is probably what's going to happen. At that point, they're just going to be W-2 employees at that point. Yeah. But you don't need to 1099 them or W-2 them or anything else like that. It's just you're forging a relationship with them. you're going to enter into a management agreement with them. You're going to come to an agreement of how much they're going to charge you. And if you're going to go in with, like, say, a 10-unit apartment or a 10-unit complex, little complex, chances are they're going to probably charge you like 10% or something like that. So again, that's the reason why, like, the bigger the deal, the lesser that percentage, right? The smaller the deal, the more that percentage. And again, 10% on 10 units, it's not cheap, but they're handling the whole thing, right? So it's important to if you're going to do that deal, try to scale up quickly, scale up as fast as you can, right? Try to buy as much stuff as you can. Don't be stupid about it. Like, don't buy just anything under the sun because you think it's cheap. Make sure the deal works. It's super, super important to make sure the deal works, right? Which leads me to number 5, due diligence. Performing your due diligence on assets is absolutely critical. It is that's the make or break of any deal, right? And when you're looking at the data, okay, like say you're using citydata.com or using one of these online resources for looking at crime stats or whatever. That's one mechanism to look at. Looking at poverty levels, you're looking at that kind of stuff. There's the physical due diligence, right, as to where the property is located, right, and what sort of environment is it in, right? That there's that. Then there's also the physical aspects of, like, what does the property look like? What does it need? Does it need any type of repairs? Is it made out of brick? Is it siding? Whatever. There's that aspect, but then there's also the financial due diligence too. The financial due diligence is so easy to fake, very easy to fake. You have to be extremely careful, questioning everything. Like it's funny. So last year we put together an underwriting group, right? So what we would have is we'd have people that would we get on a call with a select group of people. It was like a membership based type thing, and then they'd bring a deal, and we would all analyze the deal. Like, so they bring a deal, we'd sit down, we bring it up on the screen, and then we tear that deal apart. Okay. And so the person who's bringing the deal, they're all excited about the deal. Oh my God, I love this deal. I love this deal. But here we are, we're tearing it apart. Oh my God, this deal sucks. And here's why. And there's this, and there's this, and you're hammering it, and you're hammering it. The reason why you're taking that approach, and I always take that approach, even to this very day, I try to find reasons to kill a deal. I go in trying to destroy that deal from the time that I lay eyes on it. Why won't it work, right? Because if that deal survives after all the criticism that I can muster, then it's a good deal. But I always go in with a critical eye, right? So my intent was not to hurt the rest of the people on the call. The intent was to really be super, super critical of the deal itself, to the point where it's like you're trying to kill it. You're trying to destroy that deal, right? And that's one of those things that you really have to do, right? Because again, a broker will tell you whatever they can to sell you anything. You kind of have to put that all aside, right? And when it comes to the financials, I'll give you another example. I had one gentleman that I knew. We're going through the financial due diligence of a deal, and we noticed that there was a 22 unit deal, small deal, or 28. No, I think it was a 28 unit. It was a 28 unit deal. But I think like 11 of the tenants we discovered all worked at the owner's restaurant. That's strange. Why is that? And the only reason why we knew that is because we requested applications, of which there weren't any, and they were just fabricated. Right, almost like immediately, right? It was really weird. But then again, that negative, so you bring out the negative voice that comes out from the back. What's wrong with that? Why is that happening? I don't trust it. Your immediate is, I don't trust it. Why is this happening? Right? Well, I pointed it out to my buddy. I'm like, hey, dude, listen, man, I don't like this. And I don't like this whole thing here. 11 of these tenants on 28 units is bad. If it's 11 tenants on, say, 200 unit deal, it's fine, whatever. I mean, I almost expect them to stuff it, to stuff the tenants in there. I expect it, right? On a small deal like that, you're gonna have a problem. And I told him that. He didn't listen. So here's what happens. The day after closing, he fired all 11 people, all of them, right? So what happened to his occupancy? Dropped, right? And that is a lesson, right? It's a lesson that don't do that. Like, be hypercritical. So when you're doing your due diligence, you're looking at the physical aspects, you're looking at where it's located, you're looking at the income levels, you're looking at the asset itself, you're looking at the structural integrity of the asset, you're bringing in your inspectors in, you're looking at the sewer lines. I even have the sewer lines inspected. I have them all with the cameras and everything. I do all that stuff, right? I want to make sure that the property is in good shape. I'm doing all that, right? And then you're looking at the financials. Are the rent rolls all there? Are they all written with pencil? Yes, I've had deals with 200 units where the person wrote everything out with a pencil and paper, little cells writing it all out. You can imagine trying to do the underwriting on something like that. It was very, very difficult. We ended up not doing that deal because there's the financials. I couldn't get my head around the financials. We didn't do it. And the lenders didn't like it. If the lender doesn't like the deal, you don't do the deal, right? But it's very, very easy to make the mistake of with the financials anyway, it's very easy to get fooled if you don't know what you're looking for. So make sure you ask for the rent roll, the P&Ls. Does everything add up? If it's a C-class asset built in the 1960s in a cold environment, and they say that the expense ratio is 40%, that's a lie. I can tell you that. I mean, because I know just from experience, when you're running that number of assets, or I'm sorry, that old of an asset in a cold environment, expense ratio is usually sitting at about 60 or 62%, right? Not 40. If you're running an A-class asset with high efficiency windows and insulation and things like that, yes, it'll be at 40%. There's things like that you question all those little numbers, and you have to understand how that stuff works. So due diligence, super, super, super important, super important. So those are the five key aspects. Now I'm going to give you one more bonus one that really came up recently, and it's something that many new investors they struggle with. And it's totally unnecessary. And I'll tell you what it is right now. It's making the low ball offer. Okay. And I'm not saying that you should not be looking for a deal or anything else like that. But, I'll give you an example. Let's say you reach out to a broker on a 10 unit deal. It's a new deal, just hits the market, right? So it's on market because the broker is not going to know you. They're not going to give you an off market deal. So let's say just hit the market, or you heard about it from a friend, 10 unit deal, here you go. And it's $800,000. You run the numbers, you're like, oh my God, this deal works. I can make this deal work. And your underwriting's accurate. You know what you're doing. You know for sure that it's a good deal. Okay. You know it works at $800,000. But what do? You write down the LOI and you submit an offer for $675,000. Don't do that. Don't ever do that. All right. Because there's plenty of people that I spoke to that I asked them, it's like, did the numbers work at 800? And they say, oh yeah, it did. Then why'd you offer them 675? Oh, because I'm looking for a deal. Well, how much did it sell for? 875. If you would have just offered them the $800,000 and the numbers worked and it met all your targets, you would have had that sucker locked up. But you want to screw around, and then someone else came in, swooped in, and gave that guy a higher offer. You lost the deal, right? If the deal works and you know that it works, you know that it works, give them what they want. Give them what they want. When you do your due diligence, if there is a problem, you can bring it up at that point and you can negotiate that part away, and you can come up with reasoning why the number is not $800,000 now. Maybe, I don't know, maybe it's got some old sewer pipes and they're all busted up underneath, and your number is based off of everything operating efficiently, but now there's $15,000 of damage. You're going to need a little discount for that, or whatever the case may be, right? That's, you can negotiate that part. The point is that if the deal makes sense, give them what they want. Just give it to them. So many deals are lost because they're trying to, they're trying to steal it, and the key goes back to the goals, right? What I opened up with. If your goal is to deliver to buy C-class assets and deliver a 15% or a 10% cash on cash return with a 15% IRR, and you run the numbers and you put them into your sheet, and the deal makes sense, and it seemingly performs to your target, then fine, give them what they want. And when you do your due diligence, you'll decide at that point if it's really the deal that it looks like, right? The key is to get the deal under contract. That's what you want to do. You want to get the deal locked up. You want to lock it up. You want to understand it. Then at that point, the negotiation begins. At that point, the negotiation begins, right? You go through the deal. You analyze the numbers. Then maybe you find out. Maybe afterwards you do find out that, oh, of these 10 units, one of these units has been offline for 15 months. Which has happened, by the way, right? Units are just offline and they didn't tell us, right? They lied on the documentation. So it's like, okay, well, so what do you do about that now? Do you walk from the deal or not? As long as it's under contract, then you have some room to maneuver and figure out if you want to do the deal or not. But you have to get it locked up. You have to get it under contract. That's the key. That's the key. Yeah. Yeah. Cool. Does anybody have any questions? Because I've been talking for an hour straight.
I have a question for you, Agostino.
Yeah.
Are you looking for a minimum amount per door on your commercial properties?
You mean when like these days, like when I'm looking at assets, that kind of thing?
Yeah, like a minimum. Some people they're looking for $100 per door cash flow to make off each door.
I see what you're saying. Okay, sure. I don't look at it from that perspective. I'm looking more on first it starts off with percentage base. Like I'm usually targeting my minimum is like a 10% cash on cash minimum, right? If I can't meet the 10% cash on cash, the deal is disqualified immediately. After the cash on cash, there's a 15% IRR that I'm looking at. If those two match up and I can meet or exceed those numbers, then I go into a deeper dive with the asset itself. It almost, and that's just what I'm doing now, right? So I'm doing let's say larger deals where the cost per door, at least in this market anyway, they used to be $30,000 a door, right? So let's go back 2 years ago, $30,000 a door for a C-class asset in Cleveland, and if the rent was $575 a month, you can generally hit those numbers, and your expense ratio is sitting at about 55, 60%, something like that. You can hit those target numbers without an issue. These days, it's changed, right? Now the rents have gone up a little bit. The cost per door has gone up a lot because of all the influx of cash that's come in. So it's driving the cost of deals here. So I generally don't look at it as a cost per door or a return per door in terms of dollar as much as it's a return per door on percentages, right? I'm dealing more percentages. Yeah, because I think that when you're talking to investors at that point too, and let's say for instance you are raising money for these deals, they're going to want to know about percentages. Like, I'm going to give you X amount. I'm going to give you $10,000. What's my percent return? I'll give you a 10% return. Okay, I like that. That's great. I can do that deal. You know what I'm saying? It's not based on dollar return. I think that they do that in single family, right? Mostly.
Yeah, and small multi.
Yeah, that's why. Yeah, on big deals, it doesn't work that way. They don't use that metric. It's just a different metric. But that's one example though, right there, right? What perfect example of that's two different languages, right? Two different languages. If you were to say that, like if you were talking to a broker, they'd be like, "What's this guy Craig talking about? What do you mean?" So that's why it's like you want to better understand like the language. Yeah, so definitely check out the multifamily mindset on Bulletproof Cashflow on the YouTube channel. I put all kinds of stuff on there. It's all free. Feel free to listen to it.
Thanks.
Do I use accredited investors exclusively? Why or why not? No, it depends. So we got a question in the group chat from Josh. So it depends on the deal, right? Typically, there's accredited investors. Primarily, it's accredited investors. We do take on some sophisticated investors. Once we get to know them, talk to them, make sure that they understand how the deal works. We can let in a certain number of sophisticated investors, right? The key is to make sure that they understand how these deals are put together, and understand like how liquid are they. I mean, I know they're not. So I'll give an example. I know they're not accredited, and when I say accredited to guys, what I'm talking about is do they have the income level requirements? So they're making $250,000 a year. Are they worth $1 million? Do they have cash in the bank? Like, so they have, like, they can quote afford to lose the investment, right? The chances of losing an investment in real estate, if it's done properly, in my opinion, it's fairly low. But if you invest with a charlatan or whatever, it's a whole different story. But here's the thing. Grant Cardone, I think we all know who Grant Cardone is, but and if you don't, he's a social media guy. He's a real estate guy too. And he's taking a little bit of heat right now. He's getting sued, a class action lawsuit right now. And because he created a fund for unaccredited investors, sophisticated, they proclaim themselves to be sophisticated investors. What happened though, is that I remember when at the beginning of all this COVID stuff, this one guy called in. Like I think Grant was kind of like at his wit's end, so he did an impromptu phone call. And one guy calls in, like he's like flipping out. Oh my God, my kid! I got to pay for my kid's schooling. Blah 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 blah. And Grant's like, okay, well, fine. How much you in for? I'm in for $5,000. The guy was losing his mind over $5,000. Like he was unhinged over $5,000, right? And it's like, that's dangerous. That is dangerous as a syndicator. Like, and I know that we have some people that are of all levels on this call here. As a syndicator, you're putting yourself at risk to some degree. If the person if they can't live with the $5,000, you're opening yourself up to a lawsuit. So you better be careful when you're dealing with those sorts of investors, right? That's all. We typically, I like to know who the investors are that are getting on deals, or either myself or my partners that I'm partnering with. We all know who we're dealing with, So it's more than just investors. They are, for all intents and purposes, partners. They're partners on the deal. We're all partners on a deal. It's not anything else. So I kind of like to know who it is that I'm dealing with, and if I don't think that they could, like, if they were to go without $5,000 for a year or two, and they can't keep their head on straight, you're better off not dealing with that person. Let them get their money in order, and then let them come back down the road. I'd rather not take their money and let them get on solid ground before they come on board with us. That's just what I would do anyway. Yeah, I hope that answers your question. Cool. Does anybody else have any questions? Or you guys don't really want to hear me talk for another half an hour, right? No. All right.
I got another question, Agostino.
Yeah. Please.
I didn't catch your point number 2, your second point.
As far as
on the 5-6 points you covered.
Oh, the second point.
Yeah.
The
Okay,
second
that's
point
fine.
was increased paperwork. So yeah, I'll recap it. So you have different numbers, right? So you're gonna have to understand
Terminology.
the language, right? The different numbers. You have rent roll, ROI, all those things. That's point number one. Point number two, increased paperwork. You have a lot more paperwork. You have a longer time frame. Make sure that when you're communicating down the road after you learn all this stuff, when you're communicating to the brokers, you're not saying stuff like, oh yeah, 30-day due diligence, 10-day to close. No, it's not. Don't even say that. You're going to look like a newbie and you're going to lose all confidence, right? No one will do business with you, right? Number three, you're going to need more capital. You never rely just on cash flow only, right? You want to raise all the money needed to fix that deal up and keep it and get it running, right? You want to do that all the time, right? Never try to pull from cash flow of the asset to continue your renovation. Don't do that. Number four, you're gonna need a team. Okay, and I mentioned property manager is going to be the first person you call. Second person is your attorney. In those books, by the way, I think I talk about the team in there as well. So check that out. I go into a little more detail about that. So check that out. I think it's on the book on how to raise capital, the Bulletproof Guide to Raising Capital. Check that out in there. I think I have some detail in there about that. So that's number four. And number five is due diligence. I know I mentioned due diligence on several points, but I pointed out here specifically because, again, you want to understand the physical location of the asset, the physical condition of the asset, and the financial condition of the asset. You want to understand those three things about the property in deep detail. You want to understand everything about that deal. So when you do make that offer, which goes into the bonus, when you do make that offer, it's grounded in solid information, right? Solid information. And you're not just throwing out some low ball offer. That was the bonus point there. So yeah, cool.
Thank you.
Awesome. All right, guys. Well, all right. If nobody has any other questions, I guess, you know what, we can wrap it up then. So here's the thing, guys. If you enjoyed this webinar, okay, share the recording. I'll have this recording up hopefully by the end of the week, and share it on your Instagram, Facebook. I greatly appreciate it. Check out the Bulletproof Cashflow YouTube channel as well. Much of this information that I covered here is in the multifamily mindset playlist. Check that out. So you're gonna learn a great deal of information there as well. Yeah, that's it, guys. If you and by the way, when you go to the YouTube channel, smash the subscribe button, hit the like, throw up some love to me. Come on, just do that. It's good for you. It'll make you feel better. Cool. All right, guys. Thank you so much. Appreciate it. And hopefully I'll talk to you guys soon. All right.
Thank you, sir.
All right, guys. Thank you. Talk to you soon.